investor would be proud to log a $500 gain on an individual stock. But what if it means that you actually underperform the market? Well, most investors focus on dollar returns, but that mindset hides whether you're truly making progress or falling behind. So in this video, you'll learn why top investors ditch the dollar and think in percentages instead, and how that one shift can radically improve your results. And truth is, that $500 gain that you just made could be hiding a much bigger loss that you aren't even aware of. Let me explain what I mean here. And when it comes to investing, percentages give you the clearest picture of how your money is truly performing. Dollar amounts might feel more real, right? But they can easily mislead you. That's because a single number on its own doesn't show whether your return is strong, weak, or even worth the risk that you took. Percentages, on the other hand, they create context. They let you measure your results in a way that's consistent and comparable, no matter the size of your portfolio. So by looking at percentage growth instead of raw dollars, you can see whether you're actually beating the market and index funds, falling behind, or just breaking even. Now, this mindset also levels the playing field. Beginners with small accounts and professionals that are managing, massive portfolios can evaluate success the same way, because percentages will translate across all scales. It's really the universal language of investing. So instead of asking yourself, how many dollars did I make today or, this week, try asking what percentage return did I make? That single little shift changes how you measure performance and helps you see if your strategy is really moving you closer to your financial goals. Now, most people naturally focus on the dollar amount because it feels concrete. You can see it, spend it, and brag about it. But when you only measure in dollars, you risk creating a false sense of success. A monetary gain can look impressive on the surface, but actually it could represent very little progress once you factor in your overall portfolio size.
I gotta pump those numbers up. Those are rookie numbers in this racket.
Further, it's hard to compare dollar gains to something like an index fund to determine if you're investing in the right assets. So, for example, index funds generally yield a 10% return each year over the last 100 years. But if you're measuring your return in dollars, you can never compare your strategy to see if you're doing better or worse.
Making $500 sounds great until you realize it was a 1% return and the S&P did 4% that week.
Exactly, Tiara. And this is exactly why focusing on monetary gains isn't that helpful. And here's the real problem. Focusing on dollars can influence your emotions. Now, if recognizing these emotional investment traps, that can hurt your return sounds helpful, subscribe, as I always make sure to point them out when I see them. But the truth is, big numbers can inflate your confidence, while small numbers, they can make you feel, discouraged, even if your percentage returns are actually really solid. And that emotional swing often leads to poor investing decisions. And this is why shifting to a percentage mindset matters so much. Once you break free from judging performance in raw dollars, you'll see your results more clearly and avoid falling into those comparisons that really derail so many different investors.
If you just made
$500 and
Warren Buffett
made $5 million, maybe you did better than you think.
Now, most people think that percentages are, just about measuring gains, but they're just as valuable for controlling risk and planning for the future. So when you measure things in percentages, you can size your positions, set stop losses, and cap potential losses with much more consistency. So, for example, many experienced investors won't risk more than 1% to 2% of their total account on a single trade. That way, even if the investment doesn't work out, it won't derail their overall portfolio, and it makes sense to focus on percentages over dollars here, as your actual money will fluctuate. Percentages also make long-term goals more realistic. So instead of saying, I want to make $50,000 this year, you could measure progress in a more scalable way by aiming for 7 to 10% annual return, which makes more sense as your actual monetary balance will fluctuate quite a bit throughout the year. Now, by thinking this way, you can stop chasing big wins in dollars and instead build habits that scale over time.
Guilty as charged.
And that's the real secret of investing. Percentages allow you to manage risk better, set realistic targets, and actually stay on track for the long haul. So how do you actually bring this percentage mindset into your own investing? Well, the first step is to start tracking your performance in percentages instead of dollars. So whether you're using a brokerage app, a spreadsheet, or even just writing it down, get in the habit of recording the percentage change every time that you log into your account. Next, set your goals in percentages too. So instead of thinking, I want to make $10,000 this year, reframe it as, I want to grow my account by 11% in the next 12 months. And finally, use percentages to manage your downside. Decide ahead of time how much of your portfolio you're willing to risk on each investment in percentage terms and stick to that. This will keep your emotions in check and protect your overall progress over time. So for instance, in my own portfolio, I personally use percentages to try to stay at about a 50-50 split between individual stocks and funds so that I know that I'm well diversified, but I'm able to still have some risk. And I'm definitely not perfect myself, but you could see here in the screenshot that I'm a little off of those numbers right now, but that's where I'm really aiming to be with this account. Now, percentages, they help you measure success, but what if the secret to huge returns isn't, chasing big individual stock investments at all? Well, in this video right here, you'll find out why the slow and steady and frankly boring approach to investing often beats the so-called experts. So give it a click and I'll see you over there.